buy Bitcoin with free air. There's no second best, okay?
GM. Wednesday, 14th of August. Trade of the day. Let's look at Bitcoin. And let's look at the upcoming CPI. So we had PPI yesterday, and that has shifted the mindset of the market a little bit. So actually updating on yesterday's, I removed this earlier, but we're looking at it over here. If you remember from yesterday, the trade of the day played out nicely with a quick long trade, excuse me, where if we take, it was Monday's range, right? It was Monday's value area. And we go from Monday to close, it was there. And then we had value area high over here. Early on Tuesday, I tried to reclaim it, failed. And so at this point, I did it where? It was probably about here that I did it, yesterday morning. We moved down. We failed to go lower. So I mentioned this, if it breaks down, the only place to take a short would be there if it confirmed weakness. Otherwise, it came up here, broke out, went to Monday's high and up to the highs. So there was a green squiggle there. I removed it because these charts are getting messy. But you can see yesterday's trade of the day. I saw a few of you took the trade using your own systems. Love it. Love to see it. Now, I am not looking at this to continue necessarily. I'm looking at this saying, okay, there is going to be longs chasing into this and they're leaving themselves open to a flush down. Like super easy. So I'd be very, very, very mindful of what happens today. If we hit Sunday's high over there, it's going to be liquidity there. And of course, if we hit last week's high, we are at the March to July value area low. So this is a higher time frame value area that needs to be reclaimed. So finding resistance there, completely normal. If we flip that and we can flip this high, you're looking at 62.8. We're then looking at the blue level above. There's some levels above as targets. But I want to kind of revisit what happened yesterday. So at 12:30, the inflation numbers came out and they were positive. Right? We saw lowering PPI inflation, not crashing, not recession type of deflation. It was just nice, cool off in inflation, the rate of inflation. And market rallied off it, rallied all the way up into the highs. Now, I'm already seeing, on Twitter, I've seen people saying, oh, was the CPI numbers leaked? Because we pumped. I was like, oh my God, just fucking so retarded. So the market seems to be expecting now, because we had good PPI, the market expects that we have good CPI. So what happens if CPI comes in good? Market is probably positioned for it. So I would not be expecting that. Again, remember, the best way to trade the economic data is don't look at the number. The number matters for algo trades, like in the 1 minute, 1 second chart. If CPI, which I think is projected to be 3%, isn't it? Isn't that it today? CPI is expected to be 3% year over year, 0.2 on the monthly. If it comes in lower, 2.9, 2.8, 0.1, or even not, flat, the market will absolutely pump in the short term. So the first thing you'll see will be a pump here at 12:30. If we see it lower, you'll definitely pump. Now, it'll probably pump to there, take out those highs quite easily, maybe take out the Sunday high. But at that point, positioning is way offside for a quick down move. And it can just come down, flush, into here, reaccumulate, consolidate, and then the actual directional move can absolutely be higher. But the short-term positioning, try not get trapped into getting max long because you see a good number. The number is only traded by the fastest. It's just a race. And you're not going to beat high-frequency trading algos. That's not your game. So allow the news to come. Allow the market to play out 10, 15, 20 minutes. You know, I've talked about this a million times. And then you'll see the positioning move thereafter. So I'll show you what happens. You know, forget a fresh chart and forget any levels. Levels mean nothing here. The only thing that matters here is the logic behind what happens leading into a big number. So everyone's eyes are all on the CPI today. This is a big number coming up, and what are we going to see? What you see before is the market can barely move. Why? Because positioning is not at a level where anyone has confidence. short term. You have very thin pricing before. Nobody wants to trade, right? Before an unknown event, and this is exactly how professionals who trade, actual professional day traders who either trade independently or trade in big firms, the number one thing that you're taught as a day trader around economic data or market moving news is do not carry risk into it. If you don't have an edge, if you don't somehow have insider information, which fucking nobody does, practically nobody, right? If you don't know what the number's going to be, you don't carry a trade into it. Why? Why would you be long here when you know that this, whether it's good or bad news, could do that? And just take out any of the even more. It could take out all the stops, and then continue. The reason why this happens is because, and I've shown this before, but I'll show it again. Normally you would think there's going to be sellers here, right? So there's going to be liquidity on this side where people are waiting to sell, and there's going to be liquidity on this side where people are waiting to buy, in terms of your market liquidity, the depth of the market, right? Where you're going to have sellers there and buyers here. If you know that a big number is coming, you are not going to put your sell orders there. And gradually, as price gets compressed, it draws liquidity away from that area further and further out. Why? Because people know that as this number comes, it's likely to move the market more. So you don't want to be someone buying or selling 61.1 or 61.3 or buying 60.6 or 60.4. Because you know that the number has potential to move it wider. And because of that, it draws liquidity away, and then it becomes self-fulfilling. Because traders know there's going to be more volatility, they don't want to quote, right? Market makers don't want to quote bids and offers tighter. They widen it out a bit, and then other people widen it out a bit. And as people do it, it widens it, and then that makes it thin. So that leaves gaps here. And that's why those gaps get exploited. If you go back and look at like last month's CPI, so that'd be around the probably it was a Tuesday last month. It was July 11th, so it was actually the previous week. We have Thursday 11th of July over here, right? And we have the 12:30 candle was there, and so here was price before it. So in the lead up to it, price was not moving, right? And then it started to move up into it. But you had, again, liquidity. If we're just leading right up before it, you would have buy orders, you would have sell orders. This is the candle, right? But right before it, you see that why would anyone want to put their sell orders here? Let's just look at the upside. Why would anyone want to put their sell orders here right before the number? They didn't. They draw liquidity away. And on a normal move, it probably would have went to 59.1. But because the number was coming out, people just left an area they did not want to touch, comes all the way up until they do want to touch it, till there is an area of actual liquidity. And then what happens? When it fails there, it drops all the way down. And again, same thing. People try to stop it here, but they don't want to because there's higher volatility. It's not able to hold, goes all the way down. This wider volatility, this widening of spreads, this lack of liquidity is self-fulfilling. It has nothing to do with whether CPI comes in bullish or bearish. It has everything to do with how traders view that day. You are taught, do not quote close to price when you have a big number coming. If you know that something could be coming that could move the market, let's say, if you know that it could move the market 1%, 1.5% up or 1.5% down, you're not going to quote 0.5% away from price. So it thins the books out. There's less liquidity. So then when the algos come in, they start buying or selling at the news. It moves faster. It moves further because there's less liquidity until it reaches an area where there is liquidity. And that's where you want to look at, okay, before we go into today, are there any areas of inefficiency that need to be filled in? And it's just like last month. It's just like the non-farm payrolls, which I want to show over here. If I look at, let's just go on a 15-minute chart and look at some of these areas. Above, we've actually already tested this level, right? So, sorry, but this, fuck me, man. Well, there we go. We already hit that level there. So above that, there's no inefficiency there. And above that, there is up to here. So there is an untested area all the way up there that we could go and hit. That's definitely one to keep an eye on. This one's already been hit, so we can knock that off. And then below, we've got loads. There's one. And then down below that, I mean, this is pretty clean. It's retested and filled most of these inefficiencies, at least on the 15-minute chart. So there's one below. And then, of course, if it goes way lower, which it may or may not do, I don't know if it necessarily will. But you've got some inefficiencies all the way down there. But in the immediate market, where have we got two inefficiencies? We have got one below, probably 1.5% below price, and one about the same above. And I think one or both of those will get hit today at some point. Whether it's bullish or not, it will probably hit one or both of them. Unless we get this is where the number does matter. If we get a really favorable number and the market is very much imbalanced and it moves beyond, it can go higher, and it can go higher for a while. And it might not be until, days later, it eventually comes back down, right? It might take a bit longer. Wednesday might be just a trend up, and it might reverse Thursday. It doesn't have to all happen on the same day. But you can see where this exact thing happened. I'm pretty sure it was the last NFP. And I showed this I think it was on a trade of the day back then. And if we look at it here, we go Bitcoin chart. Take off some of this. Go to 15-minute chart and go back and look at Friday of the start of the month. It was over here. Friday. It was the previous Friday. Friday. Where are we? Here. Yeah. All right. So going into last month, so the CPI came out, the non-farm payroll came out here, the unemployment data, and we had this gap above, right? That was left before. So let me just replay mode it, go back and look. Right, so before that number came out, we had gaps here, we had a gap down to there, and we had an untested area over here. Those are some areas that had not been properly retested, some above, some below. When the number comes out, you get the volatility, it hits the upside, it hits the downside. That is a standard data release move. Clears out positioning, retests the inefficiencies above and below. If something similar were to happen today, you would see that either a move down and a move up, or vice versa. And then after that, right, once the move happens, then new flows begin. So what happens here is just short-term positioning noise. Nobody wants to trade here because they know the number's coming. The number comes, the spreads are wide, price blows out. Then, after the number is out, the market has digested it, the shorts get wrecked, the longs get wrecked, whatever. Then after that, you start to see the new flows. And if the market perceives it as bullish, you'll start to see new flows driving the market higher or lower. And at that point, you'll see a more directional move, right? Whether it's up or whether it's down. Obviously, after the NFP, we first wiped out all the positioning, and then the market continued in the direction that it was going to be going, which was down. We obviously had all the fears about Japanese yen, blah, blah, blah. Those fears have pretty much subsided. So it's not like there's any major shock fears to come to the market here, at least that we don't know of. But today, the first thing you're looking at is short-term moves. And after that, we're talking hours, talking 4, 5, 6, 7 p.m. UTC. Later on, the actual flows start. So we'll see how that goes. But before we leave, or before we go into today's number, same thing applies. Don't carry positions into it. Don't react to the number in the millisecond after it releases. Allow the market to start to move. Allow it to find some balance. Wait for the new flows, the new traders to come in, because we have new information. Whether inflation's good or inflation's bad, you'll see new traders, new flows come in, and then you see some direction move. And that's that. GM.